on Prophecy in Rabbi Sacred. Let's look at preparing group financial statements, and in that, accounting for interests held by non-controlling shareholders. They were previously called minority shareholders. We're going to look at two aspects here. What is non-controlling interest? That's the ownership interests of the minority shareholders in the subsidiary, and how to calculate non-controlling interest when preparing group financial statements. So what is non-controlling interest? It is, if you look at a business combination, and if that business combination has an ownership less than 100% of parent investing in the subsidiary, what it means is that the subsidiary will have shareholders other than the parent. Those shareholders are called the non-controlling interest shareholders or the minority shareholders. When we combine the two entities, which is called the group, this group is represented by the parent, who is parent's shareholders, who are the parent entity and also in the subsidiary entity, and the non-controlling interest shareholders who are in the subsidiary entity only. If you look at an income statement, if that is a group income statement, then the profit of that group, part of it is attributable to the parent entity. That's the parent entity's interest based on the ownership of the subsidiary, and also the parent is paying parent's profit as well for the group. And then there's profit attributable to the non-controlling interest, who are the shareholders in the subsidiary. So we need to provide a certain portion of that profit, attribute that to the non-controlling interest shareholders. If you look at the balance sheet will have, the group balance sheet will have the assets and liabilities, which are controlled by the parent, being the controlling, having the controlling interest of the subsidiary, and that is supported by the ownership interest of the group. So the ownership interest in the group is represented by the shareholders' equity, and part of the shareholders' equity in the group is attributable to the parent entity, and that's called the parent entity's interest, and part of it is attributable to non-controlling interests, who are shareholders or owners of the subsidiary, and a portion of each capital type in the consolidation balance sheet should be assigned to the non-controlling interest shareholders. But when presenting group financial statements, we show the group shareholders' equity, and then in the notes, in the breakdown, we provide the parent entity's interest by those capital types, by each of those capital types. But for the non-controlling interest, although we calculate for each capital type, they are aggregated into a summarized figure or a single figure, and that is presented as a single figure. So you would see when in the consolidation balance sheet that if you add the shareholders' equity, you're adding the each component or each type of shareholders' equity is the parent entity's interest, and then with that, the non-controlling interest is added together to make it the total equity in the group. So if you look at two entities, here, the John acquiring Sarah's company, 60% of Sarah's market value, you will see John controls, after the acquisition, John controls the net assets of the parent and also the subsidiary. But in the group, John owns 100% of parent and then 60% of the subsidiary, and then Sarah still owns 40% of the subsidiary. So this 40% of subsidiary are called non-controlling interests. So the parent controlled assets and liabilities of subsidiary, and therefore the assets and liabilities are shown in total, but the subsidiary's ownership is analyzed to determine the non-controlling interest, because the shareholders' equity is based on the ownership interest, and that is broken up on parent entities' interest and the non-controlling interest. So I'll play this video for you to understand what is non-controlling interest, and then once when you watching the video, think about what is non-controlling interest, how much group profits should be assigned to non-controlling interest, how much group balance sheet should be assigned to non-controlling interest. What if there had been intra-group transaction? Would a non-controlling interest of the group be assigned a share of the intra?
Hi everyone, and welcome to bonus lecture of section 6. What is non-controlling interest? Well, non-controlling interest, also called the minority interest, is the share of ownership in a subsidiary's equity the parent company does not own. When a company owns a majority stake and controls a subsidiary somewhere between 50% to less than 100%, so it doesn't own the subsidiary 100% shares, it's not a wholly owned subsidiary, but controlled and a majority ownership is the case, it consolidates the subsidiary's financials into its own, as if it owns 100% of the shares. So it's what the accounting principle states. If you control a subsidiary and if you have shares as a parent company, if you have shares over 50% but less than 100%, you consolidate the subsidiary's financials into yours as if you own 100% of the shares. However, in reality, the parent company does not own 100% shares of the subsidiary, meaning that not all of the consolidated figures in its income statement and the balance sheet belong to parent shareholders. In return, what parent does? The parent company books a minority interest in the equity section of its balance sheet and subtracts the income attributable to minorities in its income statement, because the portion of equity and income are not owned by the shareholder of minorities. So it is called non-controlling interest or minority interest as a result of accounting principles of consolidation. So here we have an example just to give you a better illustration of what non-controlling interest is. We have on the left hand side the pre-deal and here the post-deal. So let's say there are two companies, company A and company B. And here you can see the income statement and the balance sheet of company A and the income statement and balance sheet of company B. And we assume that company A decides to acquire company B, 80% shares of company B. So company B becomes a subsidiary of company A. Now let's check the figures quickly. The company has revenues of $1 million, net income of $200,000. So net income attributable to company A's shareholders is $200,000. And in its balance sheet, company A has an equity of $500,000. Company B, on the other hand, has $200,000 of revenues, smaller company, net income of $60,000, which all are attributable to company B's shareholders, $60,000, and its equity is $100,000. Now assume that company A acquired 80% shares of company B. Now we are looking at the post-deal case. We know that company B's financials will be consolidated in company A, the parent's financials, since it controls company B and owns a majority stake at the company. However, it does not own 100% of company B, meaning that some of those consolidated figures actually will belong to someone else. And the someone else in this case is company B shareholders. So let's check what happens in the income statement and balance sheet of company A. The revenues go up. We add these two numbers, 1.2 million. Net income, we simply add these two numbers, $260,000. However, this is where magic happens. 80% of this net income. So when company A bought company B, it bought 80% of it. So net income of company B, actually not 100% of company B's net profit is going to go to company A shareholders, but only 80% of it. That is why the remaining 20% has to go to company B shareholders because they still own it. So we have to subtract 20% of company B's profits, and we will attribute them to company B shareholders, which is called net income attributable to non-controlling interest or minority interest. In this case, $12,000, 20% of this $60,000 of profits of company B. And here, as you can see, so the remaining amount, the $248,000, will be the net income attributable to company A's shareholders. The $200,000 they already had before company B, and 80% of $60,000 of profits of company B. And in the balance sheet section, we have now equity. We simply multiply 80% with $100,000 equity of company B and added it on the $500,000 of equity of company A, which gave us an equity of company A, $580,000. However, here, we added the remaining $20,000 into company A's equity as well as minority interest, because this belongs to someone else. But still, we consolidate these figures as if 100% is owned by company A. But we give information, we show it that we do not own 100% with the net income attributable to minority interests and the minority interest section in the balance sheet. This will be important when it comes to valuation. We will talk about minority interest and non-controlling interest and how it affects a company's enterprise value and equity value in the valuation sections of this course. So that is all about
these four questions that we have raised. You may want to pause the video here and then start, but I will continue to the next slide. So the last question that we had was, when we combined the parent entity and the subsidiary entity, we have to assign a portion for the non-controlling interest. So it's, if the question is, if you just add it up, and then if the non-controlling interest is 40%, can we just give 40% of the subsidiary, because non-controlling interests are in the subsidiary of subsidiary to the non-controlling interest shareholders. What if there are intergroup transactions? Then the question arises, how we're going to apportion the intergroup transactions. So to look at this situation and to analyze, because it gets complicated with intergroup transactions, what we do is the analysis of non-controlling interest, we break it into three parts. At the acquisition date, how much should be given to NCI or the non-controlling interest, and how much should be given from the acquisition date to the beginning of the current year, and then how much should be given from the current year's profits. So the step one is at the date of acquisition, how much should be given to NCI, and step two is how much should be given from the date of acquisition to the beginning of the reporting period to NCI, and third is how much should be given from the profit that was made during reporting period to NCI. But when we give anything to NCI, we have to ensure that they are given after adjusting the earnings related to those periods with the intergroup transactions, because the intergroup transactions disturb or moderate or intervene with the direct addition, because that's going to change that direct addition of the accounts of parent entity and the subsidiary to come up with a group accounts. So if you take 1st of July 2012, John acquired 60% of subsidiary, then the 1st of July is the step one, date of acquisition, and there's acquisition interest, the shareholders' equity in the subsidiary, and we have to give the non-controlling interest portion at that date. Then from 1st of July to 1st of July 2013, so that's the previous period, and after adjusting for intergroup transaction, any increase in shareholders' equity, especially profits, earnings, retained earnings, should be given to non-controlling interest. That portion should be given. And in the current period, profits after adjusting for intergroup transactions, that is from 1st of July 2013 to 30th June 2014, that proportion should be given to non-controlling interests. So step one is the pre-acquisition equity. After consolidation adjustments, we have to give the NCI's portion. We should assign. Step two is change in equity of the subsidiary. We are looking at the subsidiary. For non-controlling interest, subsidiary resides in the non-controlling interest resides in the subsidiary only. Change in equity of the subsidiary from the date of acquisition to the beginning of the reporting period. After consolidation adjustments, we must give it to non-controlling interest, their portion. And step three is profit after tax on the subsidiary after adjusting for consolidation adjustments. then we give a portion of that portion to non-controlling interest from the subsidiaries adjusted profit after tax. When we assign non-controlling interest, we have to ask the question about the goodwill in the group, because the goodwill in the group, it is 100% parent acquired or based on the ownership percentage, depends on how the non-controlling interest is measured. They are measured at fair value. Then we have to assign the parent. We assume that the parent acquired the percentage of goodwill based on the ownership. Whereas if we take the notion that NCI is measured at proportionate share of the subsidiary identifiable net assets, then we take the position that the parent acquired 100% of goodwill, and no goodwill as a result of that will be given to non-controlling interest. But if we take the position that NCI is measured at fair value, then that portion of goodwill has to be given to non-controlling interest. So step 1, step 2, step 3. Step 1, market value of equity of the subsidiary at the date of acquisition, give percentage of that to NCI. Then the change in equity from acquisition date to beginning of the year of the subsidiary after doing the consolidation adjustments. We give percentage of the NCI. Then step 3 is profit for the year of the subsidiary adjusted for intergroup transactions. Give a percentage of that to NCI. So if we take an example here, a parent paid 10 million to acquire 60% shares of subsidiary at 1st of July 2007, and management of parent entity measures any non-controlling interest in the subsidiary at fair value. So that makes a call here that how much goodwill should be assigned to non-controlling interest, or because there are two ways to measure the non-controlling interest by parent. At the date of acquisition, subsidiaries entity recorded 6 million book value comprising share capital, reserves, and retained earnings are given. At the date of acquisition, the fair value was higher than the carrying value of machinery, given the cost and accumulated depreciation at that time, and then we are given the depreciation rate of machinery of all entities as 10% and depreciated on a straight line basis. During 30th June 2009, that's the current year for this example, subsidiary sold inventory costing 5 million to parent for 11 million. Half of the inventory is still on hand. So it tells us that there was an unrealized gain up to 1/2, and there's unrealized overvalued inventory up to 1/2. During 30th of June 2009, subsidiary paid 2 million of interim dividend and declared 4 million of final dividend for post-acquisition profits. So part of this post-acquisition profits of subsidiary has been used up for dividends, and the parent receives these dividends, or parent earns these dividends, and parent would record them. Profits at 1st of July 2008, that's the beginning of current year, of the subsidiary was 4 million, and profit after tax for the current year of the subsidiary is 1 million. So we are required to eliminate the investment and Part B to conduct fair value adjustment on the machinery and subsidiary as a consolidation entry. Part C is income tax impact on the fair value adjustment. Part D is depreciation adjustment for the current period due to fair value adjustment. And then Part D is income tax impact on the depreciation adjustment for the current period due to fair value adjustment. Part F is pre-tax gain or loss on sale of inventory and its associated tax. Part G is dividend payments by subsidiary to parent. And HIJ calculating non-controlling interest at the beginning of the year. At the date of acquisition for HCI, Part I is calculating non-controlling interest from the date of acquisition to beginning of the current year, and assigning non-controlling interest to for that period, step 2. And Part J is determining non-controlling interest for the current year. So Part A is, we have the elimination entry here, and in this elimination entry, before we do the elimination entry, we have to determine how much is the revaluation surplus of the subsidiary, because part of the revaluation surplus will go to the to non-controlling interest. Let's take as revaluation surplus is calculated, and then out of the shareholders equity, we will make a note that a portion of this have to be given to non-controlling interest, and let's make notes as step 1 is relevant to step 1. We are not calculating, we are not giving anything from the investment in subsidiary, because we are actually looking at the shareholders equity only. We are analyzing shareholders equity of the subsidiary only. Then we are doing the fair value adjustment. We record for Part B, we record the revaluation and the tax impact of that. And then the revaluation surplus that we have stated here, this relates to because we are now preparing to financial statements 2 years after, we need to update the depreciation expense, increase it for the current year and the previous year. And there's accumulated depreciation for 2 years. And the tax effect of that is also recorded here. The tax expense will decrease for this year and the previous year. That's recorded, and that will decrease the deferred tax liability that was generated when the asset was initially revalued. We need to make notes here for the opening retained profits and current period expenses are related to step 2 and step 3. So we make notes here so that we can later calculate non-controlling interest under the 3 steps. The sale of inventory by subsidiary to parent, their sale and cost of goods sold, so that's step 3. And the cost of goods sold is now we have to decrease the unrealized earnings and the valuation, but that's limited to 50%. So we debit cost of goods sold and credit inventory, and the tax effect of that is restricted to the 50% of valuation. So debit deferred tax asset and credit income tax expense. For us, what's important here is any current period transaction relates to step 3, and we make notes here for the, for the anything that relates to revenue, expenses, shareholders' equity, opening profits, revaluation reserves, because we are analyzing the equity portion of the subsidiary, not the net asset portion of the subsidiary, because we've taken a conscious decision to analyze the equity portion of the subsidiary rather than the net asset portion of the subsidiary, which is the mirror image of the shareholders' equity. There's dividend, interim dividend that was paid out. So the consolidation journal entries acknowledge that they relate to step 3, and the final dividends to be paid out, but they are earned by the parent, and the consolidation journal entries we make notes, and so they relate to step 3. So as mentioned, anything about assets and liabilities, we do not have to pay attention because we are analyzing the shareholders' equity of the subsidiary. So when we are calculating step 1 of the non-controlling interest, we take the gross share capital of the subsidiary, retained earnings, and revaluation reserve. There was a revaluation reserve of 1 million, but in addition to that, because the asset, there was a subsidiary's asset that was revalued after tax, it became 5 minus 1.5, 3.5. So to keep the revaluation reserve increase for the group of the subsidiary to 4.5 million, and the goodwill 4.3 million is for 60% ownership of the parent, and we cross it up to make it a 100%, and 40% of that should be given to non-controlling interest. So we calculate the 40% for each of those, and we assign that to non-controlling interest, which totals up to 6.67. The step 2, our starting point is the subsidiaries' opening retained profits. So the opening retained profits is the increase in retained profits. So opening retained profit was 4 million, but at the date of acquisition is 2 million. So the change in profit was 2 million. There was no change in share capital or revaluation surplus in the subsidiary during that period. So we had to assign 40% of that to NCI. In addition to that, when we were doing the intergroup transaction journal entries, consolidation journal entries, we had a debit of 0.5 and a credit of 0.15 for the depreciation, additional depreciation expense that we had to record because of the revaluation. 40% of those should be assigned to non-controlling interest. So when we add all of them after assigning 40% interest, it becomes 6 million. Step 3 is calculating how much should be given from current period profit. Profit after tax for the year in the subsidiary is 1 million. We should assign it 40% NCI. And then in addition to that, because of intergroup transactions, there's depreciation expense arising from revaluation in the current period, and the tax impact, tax expense of that credit that have risen. And then there was intergroup transaction where we decrease the unrealized gain onto cost of sales, so that debit, and then the income tax the impact on income tax expense. It decreases income tax expense, and that's 0.9. So we assign 40% of each of these items to non-controlling interest. So when we add up all that in step 3, it becomes a loss situation of 0.58 million. We don't necessarily have the sale and cost of goods sold of 11 million, although they're current period transactions, because they will have the net effect is 0. But if you do want to, you can add it, but the net effect is 0. So it's not added here. It's not shown here. So when we summarize step 1, NCI, step 2, NCI, and step 3, NCI, and in addition to that, now that we have got the NCIs, interim dividend was paid out, and from that 40% is given to NCI. So that decreases because they are getting cash. They are getting that equity is getting now less because that's been given out to as personal funds to shareholders, including NCI. So 40% of that will decrease the NCI portion of the shareholders' equity interest of NCI in the subsidiary. So we decrease for interim dividend, and for final dividends also we decrease. So we have to include that when we determine the total non-controlling interest in the group, and when we include them and add all together, then the total becomes 4.35.